Hello and welcome back to another episode of the RSEB Podcast, where we talk all things related to the capital market. Today, we're once again here at the Corporate Regulatory Authority's office joined here with Registrar of Companies, Sir Karma Yeshey. So hello, sir. Thank you for joining us once again.
Welcome. Thank you for the opportunity.
Yes, so in the last episode, we talked about the amended and also the new regulations in regards to capital market and the companies. So in this episode, we'll be focusing primarily on the capital market and even more so on the new IPO regulations, also the amended regulations on the IPO. So there are a few exciting ones. So before we get into the detailed ones, maybe sir, you can just give us a little refresher about what has been amended in this regards to the capital market and IPO.
So when we look at IPO market or the entry of companies into the capital market, we have, of course, this has been a initiative taken by the government since the early 90s, where government started basically different ventures in different sectors as a pioneer initiative, and then invited private sector to come in. So back then it was more of privatization or divestment of government undertakings, but now we have new entrants whereby the most, I think the earliest one where private sector promoting businesses would be the mining companies, where private sector came together with high net worth individuals trying to promote mining company, and then they inviting investment from the general public through IPO. And now today I think the most recent would be the banks, the new banks which have come in, PNB, T Bank, and also the insurance companies, Bhutan insurance. Those were the recent addition to the companies going public. So when we look at that, we always focus on, of course, as a regulator, our concern is how do we protect investors? It's public money going in. How do we protect their interest in the company in terms of the money being utilized by the company and making returns, and how do they reward the shareholders or the investors? And at the same time, we also look at of course, whether the money returns that they get is reasonable or not is the prerogative of the shareholders themselves. And they have to look at definitely understand the business entity that is being floated. We also do what we do is we make sure that there are a basic minimum criteria that they have to meet. So it's when we look at IPO, we don't only look at from the perspective of just introducing a company or taking a company for public subscription of shares, but we look at, is this business something which can take care of public money or not? So the minimum thing we look at is first, have they invested something? Is there a skin in the game? Is the first thought which comes to regulators like us. So when we vet or when we review a company which proposes to go for public, we always make sure that they are already incorporated. They are a business entity registered under the company law, which would mean that they already have a structure in place. They have a share capital with a fund which is already put in from the promoters or the first shareholders. They should have put the money of their own and operate it. And they should show track record. Earlier it used to be 3 years of operation, and out of that 2 years have to be positive, meaning you should have made substantial or at least reasonable profit to show that your business is going to be profitable. But we do not guarantee, like I said, businesses cannot guarantee profitability. You can only show, you can only forecast, but that risk of business failing is equally there. So that has to be the fact which everybody should take into account when putting in money, not just go by the documentation. So same is the case when we review. So we always make sure that there is a company with the board of directors, in the company. They also should have audited books of accounts to show that yes, they have gone through a proper process of finalizing the books of accounts and showing the business financial position of the company in the right way as per the prescribed standards. So when we look at IPO and or company going for IPO, you should understand that there is a group of people who have already tested, who have already operated the business, and they see potential to become bigger, and they also see that they can make value for others. and that's when they come, for IPO.
Okay, thank you for giving us a general perspective about what has been going through the reasoning behind the changes. So maybe we can go one by one. So sir, you mentioned about like all these different industries which are being allowed to go public, whether it be from banking to insurance companies, mining companies. But now recently we found out that even renewable energy companies can also be public, right, sir?
Yes.
So what was the reasoning behind that?
Yes. It's not so much renewable energy,
Yes.
but it's basically companies which are running business using natural resources.
Okay,
Is the
yes.
right way.
Okay,
So here the idea is again borrowing from the legal mandate of the constitution, which says that natural resources of the country, be it in a private or government land, doesn't matter where they are, but now if it is like let's say mineral, right,
Yes.
very important mineral like gold, let's say if it is found on private land, constitution is clear, it belongs to the state, it doesn't belong to individuals.
Okay.
So when somebody gets a right, mining lease for example,
Yes.
is a privilege given by the state.
Okay.
It's the country giving you a privilege, right?
Yes.
You have, of course, you pay some money, royalty to the mineral royalty, mineral rent, as some call it, to the government, and you get that right. It's a privilege
Yes.
of a state. It's a common, property of the country. So when you get that privilege, you also owe some responsibility to the state as well as to the public. So what we are trying to say is, okay, you have given this privilege, yes, it's a high value, mineral or a natural resource. Let's say timber. If you get a timber right, you extract timber and then you value it and sell the furniture, you make money. If there a business model like that,
Yes,
so it's very open-ended kind of a provision we made to enable growth in the capital market.
Yes.
So what we are saying is, yes, you have given a privilege, but if you want money, if you have if you want to make value out of this, let's make it together with others, put in investors. That's where you will get money as well as you get stakeholders. You would have, you will have a lot of check mark in terms of, becoming a very socially relevant and environmentally friendly, whatever you call it. All the standards will come into place if you do that. So here, we are looking at not only in terms of sharing the benefits of the natural resources being among the citizens, but also can we do it in a bigger way?
Yes.
Give them more resource capital, let them operate with best of technology, best of mechanism in place, and create value together. And that's, I think, one of the policy behind the mining. We have a mining sector policy which encourages, even in, I think, the principle behind this constitution provision of saying the natural resources belong to the state is to distribute the benefit of natural resources equally among citizens. So there is this whole concept of broad-based ownership, meaning this ownership over natural resources related business should be shared among citizens as broadly as possible.
Okay.
Is the principle. So this is what we were trying to do, and this window is created because of that principle.
Thank you for that explanation. So, sir, next we also have the regulation which permits companies who have finished, let's say, 75% of the construction to be applicable to going public. So, what would you say to maybe potential investors to say that how can you allow a company which is not fully launched or set up in order to go public? So, if you can give reasoning there, sir.
Okay, here it may not always be a case where a company is just setting up their factory or machinery halfway through and then going public. But it could also be a case where they have a big project which has potential. I mean, it has always, when you go for IPO, you have to prove credibility of your business.
Yes.
The profitability, the viability of business has to be documented. So it can be only in the form of their prospectus where they have financial highlights, right? What they have done in the past and what can they do in the future. So there is this window of explanation or a provision within the prospectus. In fact, we can also, this window of 75% project with 75% completion going IPO is basically to facilitate people who really have a very good business, business idea or a business project, which has a very good high value, line of operation for the future, and they are in the process of setting up a plant to basically cater to that kind of a market. And they are halfway through and they're not able to, suddenly they don't have enough resources to take this through and make it 100% complete plant or machinery or factory. So here we are giving this opportunity because we feel that it is one way it will be a less burden to the financial institutions. Sometimes individuals who are running businesses, they go in, they operate their business operation or their presence may be so so widespread that they may become ineligible from the lending institutions. So you need an alternative. So this is sometimes the capital market is called as alternative financial, the market, alternative financing market, right? So this is an alternative we are giving. We are saying, look, you may not get from you may have exhausted the source of funding from other sources, but there is one more, where public can chip in the form of equity. Put them in as yours, 25%. I mean, the percentage can differ, but what we are saying is minimum that you have to put in from the promoters from the company's initial shareholders or the first shareholders is put in 75% of your investment. Again, in terms of risk, I think it's misplaced because there's somebody who has already put 75% of their sweat and risk and effort into this project. You just need to, so when you come in as a other 25%, the choice is yours. Nobody will, tell you to, on a gunpoint, to invest your money. I mean, you have to weigh the risk. Investment is always subject to risk. So you have to look at the documents. We would again encourage everybody. I mean, we are also concerned that there could be investment which may not make you money.
Yes.
But in the short term, long term, I think all of this assessment has to be done from day one. You have to see, is this the right sector you want to get in? Is this the right group of people you want to associate with? Is there some ways I want to, I can know about them? You can wait until they have gone for IPO. You have the option to buy from secondary, meaning you skip the IPO, you wait for the company to perform more number of years, and if they're positive, you put in money later. Of course, you'll pay a little bit more premium because you have to pay at market rate.
Yes.
That's different, but there are many ways and means to gauge productivity, sustainability, and viability of a business entity, right? Business operation. So that risk has to be assessed, and if you read the prospectus, I would again insist all the retail investors like ourselves to read the prospectus of a company. That is the document which gives you a window towards what kind of business you are getting into, what kind of group of people are there, in that company, running that company, starting that company. So that is, it's a win-win from our end, and we would say that this is not from the thin air. This was actually inspired by hydropower sector in Nepal. So I think in Nepal they are permitted to have private participation in the hydropower sector. So there we found this model of, basically it came from the stock exchange in Nepal and shared by our colleagues from stock exchange. So they thought this is a good win-win example where it could be duplicated in any sector. It need not be in hydropower. It could be duplicated in any sector. And there they found that after 75%, you can actually come for IPO and raise it. And this is a win-win where, the biggest effort is put in by promoters, but they are also rewarded by, having alternative source of fund to complete their project and run it.
Lester, thank you, sir, for the explanation. So, sir, finally, the one which actually most people are actually talking about is now that IPO you can qualify after only 1 year of operation. So how come it has been reduced significantly, at least in the recently from, I think, from 3 years to 2 years, now finally 1. So what was the reasoning, sir?
Okay, so this is, I would say, the most time-tested reform that we have done.
Yes.
Like I said, we have always been, when we look at the government regulatory measures, we always take this very paternalistic approach, and we don't want to do that. That has been a constant feedback from our private sector colleagues, counterparts, and we are happy that we got this feedback from everybody, in fact, from investors' point of view, and also especially the smaller companies who want to graduate and become bigger. So when we look at this IPO track record, we must again understand the context of how and what kind of companies come through this window. So these are businesses, actually not startups, which have at a concept level. These are businesses which have already operated. They could be operating as a proprietorship, for a number of years. I mean, they could have operated for 5-6 years. But what track record we are referring to is the track record of having audited books of accounts.
Okay.
Meaning they should have converted from proprietorship, partnership, whatever they were, to a corporate entity, private limited.
Yes.
And then they should have, as a corporate entity, they should have operated for 1 year. And that has to be, exhibited, or that has to be proven by a track record shown in the form of books of accounts, which is audited and vetted by chartered accountants. Professional accountants should certify that. Once that books is certified, then we accept that. But again, they are subject to scrutiny like any other company going for IPO, meaning they have to have a minimum capital, which is 100 million.
Yes.
So we are not talking about startups here. That is the first and foremost clarification we have to look at. It's 100 million, 10 crore, right? If we put it, so it's a 100 million company where promoters have already put in their money, and then now they're saying, okay, we want to scale up beyond this. We want to go beyond 100 million. Can we put another 100 million from a public? Let's say, or 50 million or 20 million. The minimum that they have to raise to qualify for IPO is 30% of the total capital that they want. So if they want to build a 200 million, so 30% of 200 million.
So they have to raise with the promoters 170. Okay.
Yes. So that's the kind of picture you have to understand.
Okay.
So it's not a startup out of India coming for IPO.
Okay.
So that as long as you know that, then you understand. And that track record, like I said, again, it's time tested because we started with 3 years. Again, thinking that can we assess them first before sending them to the market. So once it is assessed, then we open them to the market. So now we find out that because they come through a process of gradual growth to the company or a corporate incorporated company level. They have already gone through some track record, and there are track record beyond books of accounts and things which we can gauge through books of accounts. Is the thinking.
But then it also doesn't seem completely impossible that maybe a startup who can perform very well in 1 year and incorporate themselves can qualify if they have enough capital next year. That's also possible, right, sir?
Yes, but it's a little bit on the difficult part given our financing model. I would say, because banks have to go, always insist on collateral, fixed assets, right? So most of the startups don't have that. So IPO is an alternative for them. What they have to do basically is then show us that they have invested. Yes, they also mean that there are a group of people who have already shown, that they have enough money. At the same time, they also want to show that we have a business idea which public can also gain with us, is the whole idea behind this.
So sir, last time we had a little bit of a TikTok reel which we shared about the points which we highlighted today, and there was a little feedback from the viewers who were saying it might be these kind of regulations might be potentially disastrous for the investors because this is 1 year. But I think, sir, you've already clarified a little bit on why this is all vetted and tested and studied. But do you have any other things which you can reassure maybe investors who are watching this?
So here I will again very happy to note that people are showing concerns and people are expressing interest in the reforms that we are doing, and we would encourage them to do so. Again, in the future we will come up with a lot of changes. And definitely when we look at this, we don't want to immediately go into a defensive mode and say, look, we have done the best we can and what you're saying is wrong. I mean, it could be, what they're saying could be right. We will definitely, we take it with a pinch of salt. We will, of course, caution ourselves when we look at. So all of this boils down to how we then, again, like I said, visit our website, read the regulations. It's all listed there, 9 regulations, 4 revision and 5 new regulations. Please read through most of them. Some of them will give you a very good insight into what capital market looks like. How do you qualify companies? So there are criteria on capital, track record. Track record is not the sole criteria there. So you have to look at all the criteria to fulfill IPO requirements or to qualify for IPO. So company goes through this very rigorous kind of assessment through 2 or 3 steps. Like I said, it starts at stock exchange. They do the preliminary review of books of accounts, everything. Then they come here. they do, they go through a committee scrutiny
Okay.
of their document, the prospectus, the offer document, which gives you the profile, the profile of promoters, profile of company, the track record, operate the business ideas, everything, where the money will be put in utilization fund and so on and so forth. So all of these documents are there for everybody to read. Please read through. If you need guidance to talk with us, please come forward. I mean, sharing comments on social media is not going to help anybody. We better come sit together, discuss. I mean, there could be very good ideas with individuals. So we would encourage. The other thing is, if you are an investor, if you have put in money in a company, please go and attend AGM. That's your right. Even if you have one share, you have a legal right to go and sit in that AGM and question the management or the company team on what they're doing. And you can also seek financials in that meeting. So that's all I can say. Thank you.
Thank you so much for giving us your advice, maybe to the investors out there. But just to take a little bit from what Sir mentioned, I think it's important that if you want to be an investor, is to study well, whether it be the regulations whether it be Companies Act or the stock exchange regulations or corporate regulation. I think it's very important for investors to be educated before they invest. And also, like Sir mentioned, it's not very simple task for all these companies to be permitted to be going public. So there is this level of scrutiny which goes through. And I think in terms of investors should know that the powers that be are allowing these companies to go private, and also are looking at investors' protection first. So I think this might be a little bit of a summary which might clarify. But like Sir mentioned, because all these documents are still available in the Corporate Regulatory Authority's website, RSEB's website, and also maybe RMA regulations as well. So with that being said, Sir, anything you want to add onto whatever we discussed?
I would like to first thank Stock Exchange for starting this podcast series where we can. This is one way to reach out to investors, to educate them, and definitely in the future we will have a lot of other activities. I would encourage everybody to come and participate, interact with us more. We learn from each other. They'll have their ideas which we can take up and incorporate in our regulations, reforms. We are in this constant mode of reform. So we invite any suggestions that they may have. In fact, we have a feedback mechanism on our website. They can come in, just give us a feedback, or our emails are available. They can also go, our contact details are there. They can give us a call. If they want to come and visit us, we are in the former MOEE premises. Now it's Ministry of Energy and Natural Resources, MONA. So please visit us in our office. We are always here to basically guide everybody. We are always constantly in touch with the companies because they need our services. We do cater to them, but we don't see investors. The general people who have money to put into the capital market coming to us. So, and also there is this over and above the podcast series, there's Friday forums by RSEB, right? So you should participate. I mean, those are virtual meetings where stock exchange experts from stock exchange and different investor, people who are into investment and investment gurus also come and talk through that webinar series. So I would encourage everybody to make use of all those platforms to learn more and grow with us.
Thank you so much again, Sir. All relevant documents which Sir have mentioned will be in the description below, so please do check that. And if you want to follow more updates regarding all things related to the capital market, we have our social media pages in Facebook, Instagram, TikTok, and YouTube. So please do follow for daily or weekly updates. And with that being said, thank you all for watching again. Hopefully this episode has brought you some light, at least in terms of investing. With that being said, see you in the next episode. Thank you.